Hi there, and welcome to Livewire's Buy, Hold, Sell. My name's James Marley, and today we're going to be looking through 5 sectors on the ASX to pick out the best and worst stocks for the year ahead. With me to talk about the sectors on the ASX, I have Junbei Liu from Tribeca and David Mobley from ClearLife. But before we get into those sectors, we're just going to learn a little bit about long-short investing, what makes these managers different, what makes them tick. Junbei, I'll start with you. What's unique about the way you invest, and particularly with that long-short focus in mind?
Absolutely. So in my view, long-short manager, we just have more tools to generate return. So not only we benefit from the rise of the share prices, and then we also benefit from picking a share price, a company whose share price will fall. Excuse me with my voice. So in the environment where, we do a lot of research and we find this company actually is not going to meet expectations, most of the manager, if it's long only, you can only just go, I don't want to touch it. But what we could do, we place a short bet and then we generate return. Also in the environment where market is volatile, we can be very agile and jump into any opportunity because we can hedge as in short a company within that sector, and give us the money so we can buy the better quality company. So in a way, it's lower risk and generating much higher return especially in the market where the volatility is high, gives us a lot of opportunities.
Junbei, just while we're with you, over time, how much of your portfolio would be in a short position versus a long position, just on average over time?
It's funny. So the fund has been going for over 16 years, and I myself run this fund for over 5.5 years. And on average, actually average out to be half-half, which is very interesting. Despite rising markets or falling market, there's always company that you can find that will have a bad earnings result or have a great that sort of value arbitrage you can find.
Okay, great. Dave, same question for you. Market neutral strategy. What's unique about the way you invest?
Yeah, so we're a little bit different to some of the other products out there. A typical extension strategy will add some shorts into a long book. What we're trying to do is actually remove the market exposure from our product. So our short book is typically of a similar size to our long book. So what that results in is a uncorrelated return stream. We're trying to deliver positive returns irrespective of broader market conditions with much lower volatility.
Okay. Pairs trading. What is it? How important is it? How does it add value?
Yeah, so pairs trading is where you try and find 2 highly correlated stocks within a sector, where you see headwinds for one and tailwinds for another, and you obviously go long the one you like and short the one you don't. We don't do a lot of that. In our strategy, we're typically trying to find in our long book, structural growth companies that can deliver independent of the broader market. And our short book is more about trying to take the exposure down. So a lot of our shorts are much smaller in terms of position size. Some of the issues you can come into, we do pairs trades, to be clear, but some of the issues you can come into when 2 companies are highly correlated, the amount of exposure you have to put on both sides of that trade to get a return is quite big.
Yep.
So if it goes wrong, it can go wrong quite big.
Okay, Junbei, it sounds like one of those things where you say to the people at home, don't try this at home. Pairs trading, is it something that you do?
I love pair trading. Yes, don't do it at home. But, so I love pair trading because, especially if you can find 2 companies are very similar in a similar sector and you pair trade and you can find that, one has a headwind, one has a tailwind. And that actually, in that way, it hedges off all the risk that this sector faces. So what you're left with is essentially about buying an earnings growth story and selling an earnings sales story. So one of the big examples more recently is Coles versus Woolworths. Yeah, and it worked out really, really well. But that's actually quite rare here in Australia because our sectors are very small. Out of the whole, consumer staple, there's only 3 companies. So it's too narrow normally for you to be able to get a pure pair trade. So what we do is that we actually, group all the companies with similar characteristics into 5 big groups. So within the 5 big groups, then you have more companies to play with. So for example, in our growth buckets, we will have healthcare and technology companies. They're all long duration, they're all growth, they're structural leaders, and then can play pair trade within. So then this way, you have a bigger universe. Then you have the resources. You've got the property trust, you've got global cyclical and domestic cyclical. So this way, you have a lot more pair trade opportunities. And also, it gives you much better way of controlling the portfolio risks while you generate, go chase your return.
Awesome. Thanks for that insight. All right, we're going to talk about a couple of sectors. Each of our guests are going to tell us their top pick and one that they don't like in each sector. We've got a few to get through, so we're going to keep it pretty short and sharp. Junbei, I'll start with you. Financials up 26% this year to date so far. What's one you like?
I love Zip. It's sort of a growth financial, but look, it's financial exposed to US consumer, doing incredibly well with the buy now, pay later product there in the US, becoming very profitable here in Australia as well. With the US consumer conditions now picking up, I think this company will continue to track higher.
Yeah, it's been on a cracking turnaround. All right, David, same question for you, opportunity in financials?
Yeah, we really like Macquarie in that space. So there's been some short-term headwinds in their commodities trading business and in the MacCap business. But that, in our view, has created the opportunity. The asset management business continues to go from strength to strength. They've got some amazing exposure to some sectoral growth categories like green energy and data centres, they're realising assets over the next few years, which is going to drive significant earnings growth.
Okay, flip it around. What don't you like in the financials?
Yeah, I think banks as a whole, they've probably been part of the big driver of that return that you just discussed. I think Westpac, if you include all the dividends, is up around 60% this calendar year with very small changes in earnings. If anything, looking next year, we still see headwinds around NIM. Volumes aren't really growing too much. It's pretty uninteresting. Yeah, and with a valuation that's about 1.5 times book for 9% ROE, seems pretty toppy to us.
All right, David's bearish on the banks. What's the financials you're avoiding, Junbei?
I think computer share is definitely number one. I'm a bit worried about within the financial space. Great company, made a lot of money from higher interest rate. Now interest rates going lower. The earnings will fall in the double digit for the next many years. I just think the share price is probably it has topped, and it's going to sort of continue to weaken in the next few years as the interest rate goes lower.
Okay, let's switch gears to the other big sector on the ASX. We're obviously talking about materials. We're going to look at energy stocks as well. They're down 10% and 18% roughly for the year. So two of only three sectors that are in the red year to date. Junbei, any opportunities in the commodity space that you like?
Look, I do like the commodity space at the moment with China started to track up. I think, I would put my money in the BHP, the large names. I think, the company is still trading at that sort of all-time low in terms of valuation. Got a really good, strong cash flow coming through. And then with the commodity prices sort of tracking up, they're sort of almost mark to market in the upgrade cycle now.
Okay, Dave, you got something you like in the materials, the energy space?
Yeah, so across commodities and energy, we like commodities that have deficit markets with a structural growth in their demand profile.
Yep.
So we like copper, uranium and gold at the moment.
Mm-hmm.
We're less favourable on iron ore and lithium. Within, I think one of the ones that stands out in uranium is NextGen. So it's the best pre-production asset, highest quality we could find globally. And near term, it's got a catalyst around environmental approval. So yeah, that looks good.
Okay, what don't you like in commodities?
Yeah, so as I mentioned, lithium's been had some serious headwinds and still looks challenged to us. Liontown is one of the assets that we think still has significant headwinds. Typically, the worst time to own a commodity company is when it's ramping up production of a new asset, which is what they're doing right now. And that asset, given its cost profile, is probably going to end up being swing capacity in the market. So it's one to avoid in our view.
Junbei, anything in that material space that's got a few red flags for you?
Yeah, look, I got the lithium top of the list as well. Look, I think it just, the overall market condition continues to be very, very tough for those names. While some of them is doing the best they can, but the spot price remains to be very low. We'll continue to see, supply coming on. So clearly that means the market condition will remain at such soggy states for quite some time. And overall demand environment isn't really picking up as we previously expected. So I'd be avoiding that space.
Okay, alrighty. We're going to talk about the consumer. Surprisingly strong this year, up 15% Junbei, what's your top pick in the consumer space?
Look, it remains to be JB Hi-Fi. I know it traded very well, but it is one company that not only give you that cyclical upswing that will benefit from potentially future cut in interest rate and slight improvement in the underlying consumer. Also, this company will be leveraged to that whole replacement cycle of the PC, of the AI-enabled PC and devices. So, I think this company, it certainly looks expensive on historical terms, but looking forward with the earnings trajectory, I think it looks very reasonable. I'd be staying JB Hi-Fi.
Okay, flip it around. What are you avoiding?
Look, I'll be a little bit more careful with the West Farmer. I think, the company has done, share price actually has held up pretty well. Overall, the Bunnings has done very, very well, but we are seeing signs of, in terms of the home renovation side is slowing down. And particularly for the valuation this company is trading on, with the assets such as, the Kmart is now started weakening off. We started seeing obviously the lithium market has been pretty tough. So net as a conglomerate, it's been a great company, but it's just very expensive for sort of earnings growth it's delivering.
Okay, cautious on Wes Farmers. Dave, what's your pick in the consumer, the discretionary space?
Yeah, it's a large cap, maybe a little bit boring, but we're still like Aristocrat.
Yep.
It's got an amazing market position, continues to grow share. And I think that gaming business has proved to be a lot more counter-cyclical or less exposed to the cycle than what we'd previously thought. And they're continuing to deliver huge cash flow. So yeah, it looks attractively priced compared to other stocks in the market.
Okay.
On the negative, I also concur with Junpei on Wes Farmers for all the reasons she mentioned.
It's controversial. Everyone, this is like peak renovation season.
Yeah. Well, as Junpei mentioned, Bunnings has started to slow. Amazing franchise business. Kmart's also slowing. They've also got the lithium business. And if you just look at headline valuation multiples, 27, 28 times. It's hardly growing this year. There's just better opportunities in the market.
Okay, we're nearly done. We've got two sectors to go. Healthcare, it's been muted this year. It hasn't kept up with the broader market. Got an opportunity for us in healthcare?
Yeah, we like ResMed. Philips, key competitor, has been out of the market. ResMed's basically taken the entire revenue growth of the broader market. And they've done a great job on cost, so margins continue to tick up. It's going to grow about 30% this year on a mid-20 times multiple. Looks pretty attractive. On the negative, I think Ramsay's still got some headwinds. It's a little bit controversial, this one.
Yep.
But post-COVID, you still haven't seen volumes recover. You're getting negative mix shift with day surgeries continue to decline, and they haven't been able to recoup costs through their price inflation. So yeah, it's just headwinds there from me.
Okay, Junpei, healthcare sector. Got a good idea for us?
Dave has stolen my thunder.
That's all right. So double ResMed, double Bunnings.
That's right. That's
Sell
double
the sausage by ResMed.
Exactly. That's it. But then I'll pick two different ones. So I think Pro Medicus is one of the most highest quality company here at least in Australia. Very, very rare to come across quality like that. Huge amount of growth runway. Great execution by the management. Very stable customer base and a very high retention rate for this business. The growth profile is enormous. This is a company, one of those tech companies that you kind of want to buy on every dip, and it's not something that you want to constantly take profit because the runway is so enormous. So I'd put that as a buy in the healthcare space. On the other side now, when we talk about pair trade, right? Pair trade, as in when we think about how we're balancing out everything. If I pick a long, that's expensive company, it's often you want to be offsetting with another expensive company. So if I'm to pick out of healthcare, the Nanosonics certainly looks very, very expensive. I think the company has really recovered from the cyclical lows post-COVID sort of impacts. But however, market is really sort of betting on the next product to be quite successful. And we don't know when that's coming through. And it's not going to be until next year. And even when that does get approval, there'll be a lot of cost that needs to be put. There's just a lot of unknown based on, what the multiple it's trading on, just quite expensive for just the core business. And there's quite a lot of unknowns with the future. So, so that will be the one I'd avoid for now.
Okay, I love that idea. Alrighty, so we're going to finish up with the star sector of the calendar year so far. Technology up 44%. Junpei, can you still find good ideas in a sector that's ripped so hard?
Oh, absolutely. Look at, there's actually quite many ideas. One thing about the quality growth businesses is that don't take profit, right? So you just got to be them. One of the top name we like is Life 360. Yep. I think the growth runway.
You've been on that for a while.
And it's still going higher. I know there's a quarterly coming up. Potentially, often there's volatility but the investors sometimes can be short term. So if there's any volatility, share price fall on, maybe slight disappointment, I'll be buying aggressively this this company, buy on the dip, just simply because the base business is growing really fast. Then they're monetizing it by converting into more paid subscriber, and on top of that, they've got all the advertising revenue opportunity. And analysts haven't got anything, got very tiny expectations in the forecast, and compared to some of the possible numbers that they could generate, the EBITDA could double if they get it right, or not even getting it right, getting it half right. So I think the opportunity is enormous for this company. That will be our number one pick.
Okay, I'm going to give your voice a break. I'm going to come back to you for the one to avoid. Dave, let's go with you. Let's go one you like, one you don't like in the spicy tech sector.
Yeah, so in the tech names, we're trying to find next year's winners and looking at some of the emerging plays. So I think Catapult's one that's super interesting. We're sort of in the doldrums for a few years, but refreshed management team have done a great job. Got the company through cash flow break even. They're benefiting really from some really strong growth in that wearables technology in the sports management and player management space. And yeah, it looks good on a medium-term view. So yeah, that's something we like. On the negative, Ordinate's one that I'd flag. Great business, looks like a great franchise, but yeah, it's raised some money about a year ago for an acquisition that still hasn't eventuated. There's been some management churn and some insider selling, which is a bit of a red flag for us.
Okay, Junbei, final say. What's the tech stock that you're avoiding?
I'm trying to think of which tech stock I don't like. In general, they are pretty good. They just, valuation is expensive. I think heading into, I do like Xero. I think Xero is one of the high quality business. But again, we're heading into a quarterly result. Just to be a little bit tactical, when the result comes, often Xero talk a lot about costs and the like. So, and they tend to disappoint on the day. And to me, it's potentially could lighten into the result. But again, it's one of those buy the tip sort of story.
Okay, folks. Well, that's a wrap on our episode looking at some of the best and worst names across a range of ASX sectors. I hope you enjoyed that video and all the insights from our guests today. Remember, check into our YouTube channel. We're adding fresh content just like this every week.